All right, thanks a lot, and welcome. I think it's the clicker here. So I'm the Group Sustainability Manager at Liberty. And firstly, I just want to comment on the quality of all the presentations here. You know, we had Nedbank with a very interesting briefing and animation about, where they are, where they're heading. And then Netco also brought up some interesting projects within their space. For me, the bigger question is actually how do we actually achieve these kinds of ESG benefits and the ESG value adds, and that's the basis of what I'm going to be talking to here. So I'm looking at Liberty Holdings. I'm going to take you through the overview of it and how the ESG journey has been undertaken, and how we actually link that to financial value. I want to go through a model that is quite interesting to be used within a sustainability strategy perspective, and then some notes on looking ahead. So firstly, an overview of Liberty. Thank you for that introduction. I think you've covered everything that we do. But we are a financial services group that has offerings in the insurance and the asset management segments as well. And if any of you have attended our CEO's Analyst Day, you'd understand that there's a big focus on growing the company within the African market. We do have service offerings across health, property, life insurance, short-term insurance, and our asset management portfolio, but actually across all of these 16 countries in Africa. So when it comes down to sustainability issues, the board and the Social and Ethics and Transformation Committee had agreed on 5 material issues that are key to Liberty's value add or value proposition. So one is building social and relationship capital, which talks directly to stakeholder engagement. It talks directly to building relationships and how to maximize those relationships to add value. We talk to, of course, the economic portion of the EEE or triple bottom line, which is delivering sustainable financial results. There is also a portion that is, I think, almost on the tip of everyone's tongue at the moment, which is customer centricity. So there is a need to focus on customers and understand what the customers actually need, be it within a country segment and from a sustainability perspective, which ties back into building on social and relationship capital. Of course, there is the South African regime, which is our regulatory regime, which is quite stringent and very much important that we have it in that kind of way. But also navigating these regulations and compliance metrics is quite a challenge for many institutions, and that is one of the areas where we've identified as being a material issue to focus on as an institution. And then, of course, people make the business, so attracting and retaining quality employees is an imperative, especially with the sort of arena that's been changing. It's very difficult to keep and retain key staff and key talent, especially within an African context. So that's an overview of where we were, what the focus areas are within Liberty. And just to give you an understanding of what the journey was that was undertaken, a lot of this, in some instances, can be referred to as almost the tail wagging the dog in a South African context. Because what happened with sustainability uptake in SA was that there was the reporting segment driving the management of sustainability issues, with King 3, with compliance. So initially, we were listed on the JSE as Liberty Group Limited since 2005. And then subsequently, over the next 3 or 4 years, we were signatories to the UNPRI and to the Principles for Responsible Investment of South Africa, CRISA. There was an introduction of codes and legislative instruments, which then actually drove us to improve processes in terms of management of issues and of reporting. There was the uptake of the Global Reporting Initiative's guidelines on sustainability reporting. And then, of course, came integrated reporting and the integrated reporting framework, the Carbon Disclosure Project framework, and I'm sure many of you who are involved in reporting directly are very familiar with these concepts. But what happened was there was all of a sudden a whole lot of legislation that people needed to comply to, and we needed to put structures in place in order to address them. And it's only, I think, within the past 4 or 5 years that we're starting to harness the opportunities that are made available to us because of these reporting requirements. Just out of interest as well, Liberty was severely improved their reporting in terms of the integrated and sustainability reporting. We moved up from, I think, number 8 on the EY Excellence in Integrated Reporting Awards to number 1 this year. So what is this ESG and why is it actually something we should focus on? So I like having very practical examples of where this is a value add. And it's been shown through a quant study that it does reduce risk in terms of ESG, and it also has a definite impact on your returns. There was a study commissioned in 2014 with the property development segment that actually quantified using energy efficiency lighting, for instance, as a sustainability initiative, as having a direct impact on your income returns from your property management. And also it has a higher income per square meter than others without the ESG or the ESG investment. Also, there is a definite financial benefit through a Project M study, which I'll provide the link for as well, where they've actually linked, if you invest in ESG, there is a link between overall performance over time. Of course, climate change is a very topical concept, and it's something that many people are focusing on at this point in time. It's something that cannot be ignored, and we know that this is something that has a direct relation to human impact. So what this highlights is that even though climate change is a bigger, broader impact than just something that's focused on a business, business no longer exists in a vacuum. So in order for us to address these kinds of issues, it's an imperative to look at a broader perspective of how business is integrated into society, and not just look at it as something which is separate. And then, of course, there's the investor perspective. From your pension fund investors through Regulation 28 and through international companies like the Norwegian Pension Fund, there is now a much greater understanding or need for responsible business, because people are looking at what we're investing in and understanding what is it that we're screening for or not. Over and above that, in some cases, this compliance is also a very big driver for an opportunity for innovation. So as I've mentioned, compliance and best practice reporting came out of Regulation 28. It came out of our BEE codes, our King 3 codes, the IIRC, and many others, and our JSE listing requirements, which was fantastic. We pioneered this in the space as a country, and many companies had to almost scramble to get onto the bandwagon. And now that we are on that bandwagon, the momentum is increasing. And what this has done is it's created a very unique situation. So the JSE companies have increased their reporting practices, and then as a proxy, increased their management of those practices. However, one shortcoming I find is that we haven't actually utilized opportunities to the fullest. And the biggest barrier to that is actually understanding, if I'm in a company, if we're dealing with these issues, how best do we actually quantify that value? I think one challenge we face as sustainability professionals is not just understanding what the issues are and having a hard sell. I think one key requirement is being a translator and being able to translate the environmental argument or the social argument or the governance arguments into financial metrics. I don't believe that that's a necessity in terms of just from a personal perspective, but I think in the transition period that we're in, it really helps if you can quantify that in a financial metric. So when we talk to corporate sustainability, what are we actually talking to? I know from Netcare we spoke specifically about how a project had a bigger impact onto the sustainability value proposition, and Nedbank actually talked about the end result. But that middle ground is, I think, where there's the biggest chance of misstepping, or there's the biggest need for navigation in that kind of space. So corporate sustainability ultimately looks at almost a project-driven sustainability space, and understands how do you add value at a project level, which actually then expands to creating value for a company over time. So here we have 5 elements that talk to sustainability and how it's integrated within a company. And these are items that should be familiar to most corporate structures, where you'd have your stakeholder input, including your investors, your shareholders, and your other stakeholders as well, over and above your investment perspective, how that links to your business strategy, and how you'd identify your risk and opportunities, and how you'd monitor those going forward. From those elements, you're able to then develop strategies or sustainability strategies to add value. And then once you have added the value, the outcome should be your reporting or your ESG sentiment. So with this, the question remains is that, what portfolio of sustainability projects or investments would add the most value ultimately to stakeholders? And this question is, it stems out of the fact that there's so many projects, so many items out there that we've been exposed to. How do we actually quantify and say, out of these, which is the best for us to use and which would add the most value to our particular company? So looking at those two areas, I think, are the two key areas for us to focus on at this point in time. So in terms of the value driver model that we were asked to talk to, it allows for illustrating, for instance, energy management or energy efficiency by modeling what's the total amount of operating income as a function of all sustainability-related initiatives, and using that as a reporting metric. With consistency comes comparability, and with comparability comes benchmarking, and with benchmarking comes the ability to actually say how well are we doing in terms of our sustainability metrics. So this talks to value add as it says there, the aggregated resource efficiency as a percentage of operating income. How do we translate these projects into something that we can talk to in terms of rands and cents? So there's a calculation which was proposed from the value driver model, which are the S over P, S over G, and S over R. So just to go a little bit more into that, what does that actually mean? So one, it's sustainability-driven productivity, which is how much of your operating income can actually be apportioned to sustainability-related initiatives. The other one is in terms of your growth. We had someone talking about products and services or sustainability products. It's how much of your revenue can you actually get from sustainability, sustainability-driven products, and then of course your risk management. Besides our energy risks, in terms of the ESCOM crisis, in terms of the energy crisis, how do we actually manage our risks in order to maximize performance or optimize performance over a long time? So this was the value driver model that was presented to us. I'm not going to go through all the elements of this. I'd like to focus on the productivity segment. And as you can see, a lot of this talks to areas which are directly linked to company strategies. So for instance, in terms of growth, you're looking at new markets growth or opportunities, looking at how a long-term strategy translates into growth. And your risk management elements are there as well. But the productivity option, I think, is the easiest to illustrate, and that's why I'm going to take us through that at this point in time. And this relates as to how your total cost saving and your avoidance of risk actually translates to an ROE. So if you're looking at producing meaningful cost savings, going back to what we mentioned there, how do we identify which portfolio of projects to invest in? It would be, I think it would be quite commonplace to say that there are many initiatives, many projects happening at different segments within a company. And they wouldn't necessarily always talk to each other. They won't necessarily always have the same output. So how can we coalesce all of these projects into one variable or understand it as one value add? Which is actually, if you're looking at the sustainability-driven productivity, how do you quantify that S in the S over P? How do you ensure that it's aligned to some sort of strategy? And does it produce some sort of meaningful cost savings? Can it translate this value to investors or other stakeholders? These are key questions we need to be asking. One suggested response to that is a tool that was actually developed in mining called the FV tool. So I just want to take you a little bit into what the financial valuation tool is and some background onto it. So within a sustainability strategy, it's difficult to strategize without knowing what the numbers are. One of the challenges we have is sustainability is not well integrated into financial models. You don't understand exactly how to assess that. How do you actually quantify the cost of a retention strategy? How do you quantify the cost of changing light bulbs? How do you quantify the cost of putting a solar panel in? I mean, yes, you could put a financial value to that, but how accurate is that, and how does it demonstrate value in the longer term? And lastly, actually, how do you communicate that value to your stakeholders, including your investors and your other shareholders? So one such response is the financial valuation tool for sustainable investments. I know that it's a mouthful. This was actually designed by the IFC, International Finance Corporation, and is available as freeware. What it does is it evaluates something which is site-specific. It uses an Excel-based discounted cash flow model to plot what your project costs are, what your risks are, and then estimates the net present value of those sustainability investment portfolios, and basically answers these three questions, which is what is the optimal portfolio of sustainability investments? How much financial return will such a portfolio likely to bring? And when should such investments be made? I'm not going to go too much into the history of the tool, but in essence, to those of you that have known me, I actually come from a mining background and then translated into financial services. With that transition, I think comes a little bit of the thinking of the tools that were used in the mining paradigm. And actually, this was designed in order to understand what community-level investment or engagement was at mining sites. However, the elements that exist within the tool are transferable and are able to translate into something that you could use in an investment sense as well. So it was undertaken by mining companies and Deloitte initially to understand how to evaluate a portfolio of investments, and then was used by IFC and mining companies. So what are the key elements you'd actually need in order to assess a particular portfolio or a site? One is your stakeholder analysis, and then you do your traditional, your net present value analysis and your risk quantification, which is something that most companies do in any event. The tool then looks at these three areas which are highlighted in orange. Value protection, which is your indirect benefits. How do you quantify sort of the intangibles? Your quality of sustainability investments, and the value created. And this is done by linking risk into a financial model. It's also done by linking questionnaires and surveys and responses, qualitative responses, into a quantitative model. And then through a Monte Carlo simulation, which is basically just taking these variables and rolling the dice 1,000 times, you get an understanding of what the net value is to the company, or quantifying the S in the value drivers model. So one thing should be said is that it's not a total solution as yet. And as sustainability is a journey, so is the tool or response, which can be refined over time. And what it seeks to do is actually understand what are the ranges or reasonable ranges for the value of investments. Besides the direct value creation, which is your cost saving, what is the indirect benefits? What is the actual sentiment attached to that? What is the actual benefits in terms of engaging with your stakeholders and understanding if you're meeting their needs as well? So yeah, I've just put together two very basic understanding of what the value created is and what the value protected is. So I just use energy because it's very topical at this point in time. You look at the decreases in cost of inputs due to changing the light bulbs to more energy efficient ones, versus reduced risk of energy price increases or price volatility. What you then do is you could actually plot in what the alternative would be in investing in a solar PV project and measure up one against the other. So essentially, breaking it down, and I know the financial guys would love this as well, you look at the net present value of scenario B, which is with the sustainability investments, subtract it from those without, and then you actually work out what your net present value is, or your actual sustainability portfolio. There are some limitations, of course, because this is site-specific, this is project-specific, and it is also country-specific. So you have those elements playing in there, and also the fact that it's only as accurate as the data inputs that you provide. So the management structures around managing and monitoring data need to be such that it's as accurate as it can be. Just an understanding of how you'd actually quantify these risks. You'd use a risk matrix and understand what the value is for your electricity price increases. You look at your stakeholder engagement and understand what the level of political instability is within the country, your impact of carbon taxes, and these all get plugged into one model. And then you'd have your checklist. What is your sustainability investment portfolio in terms of value creation? You take your different cost and your benefit drivers, plug it into the model, understand what the differences are, and from there you'd actually say, I can plot this out into a discounted cash flow model, and I can sell this to my exec now as a value, as a concrete figure or number. So this is just an example of what some of the outcomes would be from using the tool. So in scenario A, you'd have no energy management program. In scenario B, you'd have actually one where you have your sustainability program in there. And your consultant fees, you put in your cost of products and services in scenario B versus the benefit drivers. And taking all of these items into consideration, you'd understand, how would that actually play out? Is it something that's viable for a company? Is it something I could sell to my investment team or the people who are approving projects? Or is it something that is not viable? And it helps because before you even get to that point of trying to sell it without any sort of backing, you have this as a direct number and a direct saving as well. So this just extrapolates a little bit more onto that. This is the energy efficiency project, which puts in your operational costs, which are baseline costs toward B, and your cost and benefits per year. And then this could also be linked to a performance metric, which is whether it's your 3-year performance or your 5-year performance, and how that would play out in terms of generating value for the company as well. The only sort of limitation is that you need to understand what the duration of each phase of the project would be, which is sometimes difficult, especially when dealing with the intangibles or the qualitative data. And then a lot of estimates are sometimes used in your discounted cash flow model before you get to a point where you have a little bit more robust figures on it. So the solution is actually refined over time and not something which is a direct answer which you could provide at any point in time. So we've spoken to productivity, we've spoken to how this could actually work in a very practical sense. And then just understanding, looking ahead, what is the sort of application that this could be used for? Whenever we get projects which need to be approved before budgeting happens, we have to send it through to a social and ethics committee for approval. It's very difficult to quantify a business case. And so what we found is that the tool is not a once-off exercise that gives an answer which would be the same answer every year, but more a means to actually understand how you refine your strategy or your sustainability strategy over time. And I think that's very important when considering the sustainability journey that everyone is on. There's no direct answer at this point in time, and there's no saying that this is definitely how we're going to do it. It does, however, guide our work. And I think it's very important that we mention that this is also a function of understanding what the strategic objectives of a company are, and linking those to what we're doing in terms of your sustainability work. You then be able to articulate to your set committee or your social and ethics committee which portfolio of investments will bring the greatest value, how much value it can bring, and when such investments should be made to maximize the value creation potential. And from that, you can actually articulate a stakeholder value proposition or a stakeholder value model. So when you're doing project valuation, those are the 2 areas we're focusing on. Just to take you back to the beginning, this is how the financial valuation tool can contribute to the SP model. Thanks.
So it's still 6 minutes remaining to your presentation. Do we have questions?
Hi, I'm Peter Kornhoff from Allen Gray. Firstly, thank you very much for your presentation. I have 2 questions. The first one, both of them are related to the fact that Liberty has a majority shareholder in the form of Standard Bank, right?
Yes.
So the first one is, to what extent are Liberty's sustainability initiatives independent and driven by Liberty itself? To what extent do you kind of get a push from Standard Bank, or do you try and exploit synergies between the 2?
All right, so just to answer that question, the sustainability initiatives driven by Liberty, just to give you some background, this was actually quite a new role that was introduced towards the end of 2013. Where they had a permanent placement with myself on there. Before that, it was driven by a lot by the sort of internalized initiatives at Liberty, although there is almost a dotted line, if you want to put it that way, to Standard Bank. We collaborate in terms of sharing information and sharing where we are, what we're doing, so they can actually do a lot of the reporting, I think, even as a whole. So when we're engaged in our assurance process on sustainability data, it's usually the same people would be calling Liberty, or people at Liberty would be calling Standard Bank to understand what is it we're looking at. Are we looking at the same kinds of issues, and does it fit within that model? And when it comes from a reporting perspective, Standard Bank reports on Liberty's sustainability as well, but it is independently managed.
Then the second question, the Social and Ethics Committee on the board is tasked to some extent with looking after the rights of minority shareholders, right? Can you maybe take us through on a kind of practical level how they actually do that? How in board meetings they, in addition to looking at the sort of the E and the S of ESG, they also think about the governance side of that.
So I know from the LIFPIN perspective, they are looking at, they do monitor sort of management and proxy voting elements such as that. We also do subscribe to the Code for Responsible Investing and the UN Principles for Responsible Investment. A lot of those areas, focus on representing the areas which you spoke about as well. So it is something that is considered in the management structures there as a signatory to CRISA and to the Codes for Responsible Investing as well.
Hi, thank you for that introduction to that financial valuation tool. I think it could prove to be extraordinarily useful if we saw that being rolled out across companies. From the asset management point of view, it would really aid with transparency and being able to identify how their strategies are really being thought through and relating to their operations profitability. My only hesitation with it is that in doing an analysis like that, the complexities of sustainability issues is that quite often the solutions, when they work, are greater than the sum of their parts, and how explicitly you can incorporate that in something like a DCF valuation. It's not always easy to incorporate synergies like that, and that's why I'd hesitate that kind of being used as the hard line in decision making. But thank you very much for that.
Sure, thanks. I appreciate it. Just to add to that comment, I agree fully with you. I think this is a step in the right direction, but I don't think it's the be-all and end-all. So.
Okay.
Yeah.
I only have one question. You focus a lot on financial models and everything. When do you decide, or how do you decide when to take on a project? Where do you get ideas for any projects you take on? And yeah, I see that you can incorporate financial modeling into the projects, but where's the idea coming from?
Okay, I get you. So a lot of these sustainability initiatives are taken from best practice ideas, from what everyone else is doing in the space, from an understanding of what the company's strategy is, and what is the sustainability portfolio of investments that would support that as identified in best practice or what people are doing outside there. I think what's interesting about sustainability is that we used to look at competition in terms of this person's doing that, we should be doing this. What's changing in the sustainability space, or what it's driving toward, is actually almost collaboration. So it's a competition, but it's understanding the risks are shared across an industry, across a country, rather than just within a particular segment. And if you're looking at what the development objectives are of a particular country, or what that customer-facing region is, that helps you identify solutions. And by those, those would be projects you'd look at.
We do have time for another question.
Since you, Mandy from Kagiso Asset Management, since you apply a sort of a DCF way of thinking of things, do you have an IRR target for your projects?
So there would be an IRR, but it's not something that I would say is the same IRR as you would for a financial project as well, simply because the level of accuracy of the calculation of the tool is still being refined. So it would be premature to actually implement a set IRR at this point in time.
How do you look at compliance? And is it a change of the discount rate, or?
So a compliance-based model would be a change on your residual risk, and it would the tool allows for change or change of your distribution of risk based on a set of factors. So there is no hard and fast rule to applying this. So we just make sure that in terms of the way that the project is scoped, the compliance and legislative requirements are almost taken before you actually start implementing your risks into the model itself.
Final question. What happens if a project has a negative NPV?
Look, I think it's also a function of the time period that you're looking at. So yeah, I mean, look, it could have a negative NPV, and in that case, you wouldn't have justification in the kind of using this tool for putting it forward. However, there may be other benefits that are not quantified by this tool, which would have a bigger impact. So I think it would have to be considered on a case-on-case basis.